Well, let's go back to our top stories. Just right a few minutes ago, the U.S. Fed, the FOMC, has decided in a vote of 11-1 to cut interest rate by 25 basis points. That's already priced in by the market, the first in 2025. According to a statement by Jerome Powell, the FOMC, the U.S. Fed, is likely to cut at least two more before the end of this year. We expect that to come in November and December. The one dissenting vote to the 25 basis points was Stephen Meron, the President Trump's appointee, who just went into the FOMC member as a member of the body, and that was just a few weeks ago. He decided that the cut should be by 50 basis points. President Trump wants a bigger interest rate cut, by the way. Of course, that's not very surprising that his appointee on the FOMC decided that the rate cut was a little bit smaller than expected. And that's out of the United States. Let's come back to Africa. The week of central bank rate decisions continued today, with the Bank of Ghana delivering another massive 350 basis point cut, taking the country's benchmark rate to 21.5%. The interest rate cutback was made on the back of continuing lower inflation and stronger fiscal balance. Ghana has cut its lending rate by a whopping 650 basis points since the new president, John Mahama, took office 8 months ago.
GDP grew at a much faster pace by 7.8% relative to 5.7% over the same comparative period. The services sector grew by 9.9%, while the agriculture sector expanded by 5.2%. The bank's high-frequency indicators continue to point to sustained momentum in economic activity. The Composite Index of Economic Activity, or what we call the CIEA, recorded an annual growth of 6.1% in July 2025, compared to 1.9% in July 2024, on the back of international trade activities, consumption, and industrial. The latest confidence surveys that, as firms met their short-term targets and expressed optimism about company and industry prospects. Similarly, Ghana's Purchasing Managers Index, or the PMI, went up in August, signaling increase in new orders as business conditions improved. Now, on inflation continues to ease and has been broad-based. Headline inflation declined further to 11.5% in August 2025, down from 12.1% in July, the lowest reading in 4 years. The sustained decline in inflation for 8 consecutive months was largely driven by a combination of factors, including the prudent monetary policy easing of underlying inflationary pressures. Similarly, inflation expectations among consumers, among businesses, and the banking sector all eased, affirming the disinflation process going forward. On interest rates are declining on the money market in response to the recent cut in the monetary policy rate. Yields on the money market instruments have declined significantly, and the average lending rates are gradually easing, which should lower the cost of credit in the near term. The interest equivalent of the 91-day Treasury bill instrument eased from 13.4% at the end of July 2025 to 10.3% at the end of August 2025. The average lending rate over the same period went down from 26.6% to 24.2%. Now, fiscal policy implementation in the year to July 2025 reflected strong consolidation efforts underpinned by tight expenditure controls, although revenues fell short of target. Consequently, the overall fiscal deficit on commitment basis was 1.1% of GDP, outperforming the target deficit of 2.1% of GDP. Also, The fiscal anchor, and that is the primary balance on commitment basis, recorded a surplus of 1.0% of GDP, reflecting a better outturn than the targeted surplus of 0.5% of GDP. The deficit was largely financed from domestic sources. At end July 2025, the total public debt stood at 40 asset quality and efficiency indicators. The industry's capital adequacy ratio, or the CAR, without regulatory reliefs, elevated credit risk remains a major concern going forward. And in the outlook, adherence to the recapitalization plans and full implementation of the bank's regulatory guidelines to lower NPLs will further enhance resilience of the banking sector. Now, on the external sector, the sector strengthened in the first 8 months of 2025 with a significant trade surplus of $6.2 billion compared to $2.1 billion which was recorded during the same period in 2024. This was driven by a sharp increase in exports earnings, mainly gold and cocoa, which far outpaced import growth. The reserve position remains strong with our gross international reserves at $10.7 billion, that is equivalent to 4.5 months of imports cover as at end August 2025, compared with $8.98 billion, which was equivalent to 4.0 months of imports cover as at end December 2024.